Get more on bonds and investing in fixed income. We are joined today by Cheng and his JF Asia Total Return Bond Fund invests in treasuries, U.S. dollars, and also local currency Asian bonds. And the fund has beaten both HSBC's U.S. dollar and also its local currency bond indices by as much as 22 percentage points so far this year. Good to see you, Stephen. How are you?
Nice to be here, Susan.
All right, Stephen. So let's talk about the story of the day. You see Ben Bernanke's face splash across most newspapers this morning. What about his renomination? What does that mean for bond markets?
Well, I think the bond market would be quite pleased to see that Bernanke has been reappointed. That removes kind of one of the uncertainty that might arise from policy change with a new leader at the Fed. Now, I think that with kind of this appointment out of the way, and Bernanke will be believed to be quite easily reappointed through the Senate and whatnot, we should see volatility in the bond market continue to decrease. And that should be a pretty good backdrop for corporate bonds to continue to outperform. Now, you mentioned treasuries might not be, kind of in a range, or perhaps the bull market might be over. And I don't think that would be a pretty contentious statement at this moment, because 10-year U.S. Treasury yields have hit 2% early in the year. And right now we're at 3.5%. So are we going to get back to 2%? That's probably not very likely. But, yields are probably going to stay in a range. And that should be, as I said, quite good for other kind of more credit-related instruments, such as corporate bonds.
Okay, so if that's the case, if the bull run in U.S. Treasuries is pretty much done, does that mean it's time to maybe rotate your money out of these Treasuries and into something else?
Well, I think, as I said before, corporate bonds would be in a pretty sweet spot in this environment. We still have spreads that are quite wide. These are levels that are consistent with recessionary type of levels in previous cycles. Now, we had a big spike last year because of the Lehman bankruptcy and associated kind of panic selling and deleveraging among institutions. But I think, once you kind of look back at the valuation, the corporate bond spread are still very attractive, particularly when you look at cash yields at near zero.
So I guess, Stephen, with the rally that we've seen in equities, the question is, why should I invest in corporate bonds? Why not buy the stocks, which is yielding more returns this year?
Right. I think the equity market, are right to be, somewhat more optimistic now than, say, the low in March. Now, equities have gone up very quickly in a very large magnitude. And, I think what you want at this point, depending on your risk preference, is to perhaps take something off the table. And in addition, when you look at bonds, particularly for the corporate in both investment grade and high yield, you are getting paid to wait, as this kind of recovery unfolds. It might not happen, it might happen, but in either way, you will get a pretty stable income stream with a very attractive historical spread versus treasuries and other risk products.
Yeah, what is the spread? What's an attractive spread right now?
Well, if we look at the Asia investment grade spread against the treasury, right now it's sitting around 350, looking at some of the major indices on Asian credit side. Now, that compares to probably closer to 200 basis points or slightly below that for U.S. counterpart. So I think, in terms of getting spread product into your portfolio, Asian credit product would be the place to be.
Okay, and you said it's maybe not a bad time to take some money off the table as well. I mean, how much should people be shifting out?
Well, again, it depends on, kind of your own outlook and also risk appetite. But I think, right now, if you, kind of, a lot of people in Asia particularly, I think, consider cash and then equities. Which they haven't looked at in between is actually the bond, which perhaps, if you look at kind of risk versus reward and also kind of, as I said, better winning odds, getting paid to be waiting while the recovery unfolds. I think bonds is a very good alternative and attractive alternative right now.
Now, let me ask you about corporate defaults. We're talking about corporate bonds. You say they're attractive, but S&P recently said that corporate defaults this year is actually going to be higher than defaults last year. So are corporate bonds really that safe of a play?
Well, I think, in terms of default rate, it's somewhat of a lagging indicator. Now, we had 2008 being a very horrendous year for a lot of the corporate funding exercise. So a lot of people went into trouble and whatnot. Yet the default rate hasn't really risen then. So we have 2009 probably going to be a peak year in terms of default rate. But what's important, I think, for the credit markets right now is that we are seeing the light at the end of the tunnel now. I mean, it is pretty likely that 2009 will mark the peak in default rates. So 2010 and beyond would actually see a market improvement in terms of the default rate, actual realization rates.
Okay, so Stephen, we're talking about how you like corporate bonds. Let's get into one of the names that you do like specifically, which is Bank International Indonesia. That's a unit of Maybank. Let me just ask you, why do you like this bond in particular, and is this maybe an indication that you like financials in general?
Well, I think in terms of financial, I mean, they were kind of hit very hard last year.
Yeah.
But I think what we need to keep in mind is that most of the kind of problems occurred in the U.S. and Europe. In Asia, most of the banking system have been kept very healthy. I think in Indonesia's case, particularly given the Maybank kind of very solid parent now for BII, they offered a very kind of sound fundamental backdrop. Their capital ratios are extremely conservative. And also, this bond will have a call feature next year, which I think will give you very good yield, and they would call the bond come that date.
Okay, so you talked about Indonesian bonds, which is one of your favorite plays here across the Asia Pac. Also Korean bonds as well. And today we have a lot of other analysts that we survey that agree with you on that one because, let's talk about the South Korean bonds if we can bring up that story, please. Now let's move on to talk about Korea. I guess let's just get your picks first because we actually don't have that story at this point. Korean bonds, I guess that's reflective of your interest in the won itself and how you think it'll outperform. Maybe you can get into more details in terms of why you like Korea. I guess that there's a bit of a comeback in the economy as well.
Right. I think we actually like a few things about Korea. We like the won, and we also like some of the dollar credit instrument that got issued recently. The Korean markets have been, very, in a way, getting hit very hard last year because they have a funding issue. In most of 2008, they were running a current account deficits, and that in turn, kind of make a lot of banks unable to refinance their debt, or at least gone into a situation where a lot of people were extremely nervous about it. But this year, given the won has weakened from 2008 beginning level of about 950 to at one point in March 1600, that has helped turn the trade account around substantially. They are now posting FX reserve increases. And so the situation almost reverses itself now. And given the financial market has also opened up, Korea, while still commanding a little bit of a discount versus its, kind of A-rated counterparts, provides a very attractive opportunity for us to pick up spreads.
Stephen, we're going to get a commercial break right now, but let's just try to pick up on this quickly when we get back from commercial break. Welcome back. We're going to stay with bonds, and here's a trading idea from you from BNP Paribas, and it involves betting on spreads. Specifically, BNP says the spreads between South Korean bonds and its notes will narrow. So it says go long Korean corporate debt and also go short on the shorting maturity notes by selling the credit default swaps on those particular notes. Now, another person who likes South Korean bonds at this point is our guest, Stephen Cheng of JF. And before we went to break, you were talking about the outlook on South Korea. Economically, it looks good. The currency looks attractive. But any corporate names that come to mind in South Korea?
Well, I think, we like, kind of across kind of a lot of Korean credit, particularly in the quasi-sovereign space and some of the bank names. With Korea having a lot of supply over the course of the last 3-4 months, I think people were a little bit nervous that, because of the large amount of supply, they will have to come at higher spreads. But the market has shown that demand has been extremely strong, and Korea is still, as I said before, relatively cheap on the A-rated category. And we think this will continue to narrow in and to be more consistent with other counterparts now that people might figure out that the supply has largely been completed this year.
Now, isn't this an overcrowded trade? Because you heard there BNP also suggests buying into Korean bonds. You have Western Asset Management, who's bullish as well. With so many people crowding in, is there an opportunity to actually make decent returns?
Well, I think you're looking at a situation last year where a lot of people panicked and got out. Now, a few people might have gotten more constructive in Korea, but if you look at the market, you look at the spread of Korea, it has not shown that it has been that popular yet. It's true that the spread have come back in a lot, but I would actually rather suggest that the spread earlier this year was kind of the was actually the anomaly rather than now.
Okay, well, let's talk about the other market that you favor as well, which is Indonesia. Again, I guess it's an economic recovery story as well in that particular market. But you also favor Indonesian government bonds and also U.S. dollar-denominated ones. That's pretty interesting.
That's right.
Why those two?
Our fund is very, very much trying to capture some of these pockets of opportunity Korea was the biggest overweight we have, and then the second one being Indonesia, having about a 20% weight. Now, in terms of the government bonds that are denominated in rupiah, we feel that the currency has room to appreciate. Inflation would still be going down over the next few months. The central bank will have kind of room to cut rates further. In addition, the yield itself, if you look at 10-year Indonesian government bond yields, it's about 10.5% yield right now. In the context of a market where you actually see a pretty decent currency strength ahead, compared to other, country government bonds yielding, at very low rates.
Yeah.
I think people would find this to be a very good alternative to park their money.
Yeah, 10.5% yield. That does sound quite attractive. Now, you also cited that there's a scarcity. Yeah, you want to invest in Indonesian bonds, but there's a scarcity in terms of finding these premium quality ones. How do you look around Indonesia and say, yes, that's something I want to buy into?
Well, I think Indonesia, we have a very favorable view on the country itself, particularly given that, they have this good economic backdrop of low inflation.
What about sector-wise then? How about that? Can you break that down for me?
We like certain banks. I think banks certainly have sort of the scarcity premium that are associated with them. Most of the banks now can actually finance locally without going to the US dollar market. So the US dollar bonds, in addition to the one that we mentioned, we still think that they would always command a premium until they mature. Now, we're looking also at some of the quasi-sovereign names, in terms of some of the electric companies and also some of the energy-related companies. I think, in terms of commodities and resources, those are some of the names that we favor. China has been importing a lot of commodities, and Indonesia, particular producers of those commodities will be beneficiaries.
Stephen, nice talking to you today. Thanks for dropping by.
You.
Stephen Cheng of JF Asset.